Hi, I'm Will Stewart with PC Investment Bankers. Welcome to ESOP University. Today we are talking about deferring or avoiding capital gains taxes on the sale of your business to an employee stock ownership plan, or ESOP. More specifically, we'll be discussing the requirement to reinvest your proceeds in qualified replacement property, which will memorialize the capital gain deferral. Qualified replacement property, or QRP, are securities issued by a domestic operating company, the most popular form of which are known as floating rate notes. Floating rate notes were specifically created for ESOP transactions. They are used so frequently in this type of deferral that they're often referred to as ESOP bonds. ESOP bonds, or floating rate notes, do not have much value outside of the capital gain deferral for ESOP transactions. In fact, they were created to be the perfect collateral for a margin loan. Effectively, this allows you to defer the capital gain for a long period of time, while also getting to use most of your proceeds for short-term needs. Practically, how this is applied is for every $10 million of sale, you will need $1 million of cash to reinvest in floating rate notes. Then you can use the remaining $9 million to spend, invest in a diversified portfolio, or hold for other long-term investments. Floating rate notes typically have a maturity of 40 to 50 years. They are designed to outlive you. The idea is for these bonds to pass into your estate, the basis to be stepped up, and for you to never have to pay the capital gains taxes in the ESOP transaction. Floating rate notes are typically issued by only the most creditworthy companies. Any company that's going to be able to issue a bond for 40 to 50 years needs to have a credit rating of A to AAA for investors to feel comfortable holding that note. ESOP bonds are issued by companies that fit this criteria, allowing you to feel comfortable holding debt that they issue for that period of time and knowing that the capital gain will be deferred for the length that you need it to be. Reinvesting the proceeds from your sale into qualified replacement property is a required step to defer your capital gains taxes in an ESOP transaction. This should only be done consulting with your investment advisor who's experienced in the reinvestment of proceeds in a qualified replacement property. You only get one chance to make the investment for a 1042 capital gain deferral, and it is recommended that you consult with someone who has experience in doing this. Thank you for your time today, and I hope you've enjoyed the discussion about deferring capital gains taxes using an ESOP. Please subscribe to our channel for more educational content.